Everyone wants to save tax, and lots of people want to make money out of property, but maybe the two are mutually exclusive. Property can be great because it's comfortable. You know it, you can see it, you can even go and knock on the door, and hey, people always need to live somewhere, right? But are they really that great an investment? Well, when it comes to tax, I'm going to put my controversial stake in the ground and say no. Now, before you start yelling at the screen though, let me take you through some numbers as it will simply blow your mind. So I'm going to take two retired investors who have built up their assets in different ways. The first, James, is a pure property investor, holding only rental properties. And the second, Olivia, is working with a financial planner, and she uses investment portfolios and holds her investments in some fairly normal tax vehicles that are available to absolutely everyone. Now, their assets are worth broadly the same, around 2.5 million, and their income is also the same as well. So we'll start with James, our property investor. He's getting a decent yield of about 5% from his rental properties, so pretty good, giving him a very healthy £130,000 a year in net rental profit. So how is that taxed? Well, unfortunately, all of this is taxed as income and will be in excess of £125,140. As a result, James loses his entire tax-free personal allowance. So that means every penny of his income is taxable. The first £37,700 is taxed at 20%, and the next £92,300 is taxed at 40%, meaning James will pay a total of £44,460 in tax. Now, Olivia is also taking £130,000 in retirement from roughly the same value of assets. She's doing pretty well for herself, like James, and has £1 million invested in a pension, £1 million invested in an ISA, £300,000 in a general investment account, and just under £150,000 in a bond. Now, 25% of Olivia's pension can be accessed completely tax-free. 250 grand, not bad. So she's going to take 10,000 every year from that pension tax-free cash, so it will last throughout retirement. She then takes a further 50,270 from the pension on top of that. And actually, it's only this 50,000 that she's going to take as income. So Olivia will have her full tax-free personal allowance. So £12,570 of this will be completely tax-free. It's only the 37,700 of that 50k that will actually be taxed at 20%. She then takes another 50,000 from her ISA, which is completely free of tax, and £12,300 a year from her general investment account using her annual capital gains tax allowance. So again, no tax. And finally, Olivia can take 5% in tax deferred withdrawals from her bond every year. So it takes the final £7,430 from here to make up the full £130,000. It's also important to emphasize that although that sounds quite complicated, apart from maybe the bond, on the whole, this is fairly vanilla tax planning. So if you managed to follow that at all, you might have noticed that Olivia receives £92,300 a year completely free of tax. In fact, she will only pay an annual total of £7,540 in tax. So what does this mean? Well, over 10 years, our property investor will pay £369,200 more in tax than Olivia. It's absolutely astonishing. So look, I'm not saying property is all bad, as there can be a great reason to hold it as part of a diversified investment plan, but please do make sure you take into consideration the tax you might pay. Ultimately, if your objective is to save tax, you're probably going to be better working with a financial planner. And remember, your money really does matter.